The year 2008, a year that began with a sense of unease, quickly descended into full-blown panic. The global financial system, a complex web of interconnected markets and institutions, began to unravel. The very foundation upon which global prosperity stood started to crumble. This was not a localized crisis. It was a global financial earthquake. The epicenter of this financial earthquake was the United States. Years of reckless lending practices, particularly in the housing market, had created a ticking time bomb. This bomb was primed to detonate when housing prices began to falter, and detonate it did, sending shockwaves across the world. The collapse of the housing bubble triggered a chain reaction. As housing prices plummeted, millions of homeowners found themselves underwater on their mortgages, owing more than their homes were worth. Defaults soared, and the financial institutions holding these toxic mortgages started to teeter on the brink. What followed was a period of unprecedented financial chaos. Banks stopped lending to each other, fearing that their counterparties might collapse. Credit markets froze, businesses struggled to secure the loans they needed to operate, and the global economy spiraled downwards. The first domino to fall was Bear Stearns, a major investment bank. In March 2008, Bear Stearns faced a liquidity crisis and was forced into a fire sale to J.P. Morgan Chase, orchestrated by the Federal Reserve. This event sent a chill down the spines of investors and policymakers alike, signaling the severity of the crisis unfolding. However, the true harbinger of the crisis, the moment that sent shockwaves across the globe, came on September 15, 2008, with the collapse of Lehman Brothers. Lehman, a venerable institution with a 158-year history, succumbed to the weight of its toxic mortgage-backed securities. The bankruptcy of Lehman Brothers was a watershed moment. It signaled that no financial institution, no matter how large or storied, was immune to the crisis. The psychological impact on the markets was immediate and devastating. Stock markets around the world plummeted, and panic selling ensued. Lehman's collapse exposed the fragility of the entire financial system. The intricate web of financial instruments and the interconnectedness of global markets meant that the failure of one institution could have catastrophic consequences for the entire system. In the wake of Lehman's collapse, governments around the world scrambled to prevent a complete financial meltdown. The U.S. government, led by President George W. Bush and Treasury Secretary Henry Paulson, faced a stark choice: intervene on an unprecedented scale or risk a catastrophic economic depression. The government chose to act, implementing a series of emergency measures. The most significant of these was the Troubled Asset Relief Program, or TARP, a $700 billion program to purchase troubled assets from banks. The goal was to inject liquidity back into the financial system and prevent a complete collapse. The government's intervention was controversial. Many Americans were outraged that taxpayer money was being used to bail out the very institutions that had caused the crisis. Public anger was palpable, and the term bailout became synonymous with corporate greed and government overreach. Despite the public outcry, the government's actions were seen by many economists as necessary to prevent a complete economic collapse. The TARP program, while unpopular, did eventually help to stabilize the financial system. However, the crisis was far from over. As the crisis deepened, another giant teetered on the brink of collapse. American International Group, AIG, a massive insurance and financial services conglomerate. AIG had insured billions of dollars worth of mortgage-backed securities. When these securities began to default, AIG found itself facing billions of dollars in potential losses. The potential collapse of AIG presented the government with another daunting dilemma. AIG was deemed too big to fail. Its failure, it was feared, would have catastrophic consequences for the global financial system, potentially triggering a cascade of failures that would make the Lehman collapse look like a minor tremor. In September 2008, the Federal Reserve stepped in with an $85 billion bailout of AIG, taking an 80% stake in the company. This was followed by a further $182 billion in government support. The AIG bailout was even more controversial than the TARP program, fueling public anger towards Wall Street and the government's perceived complicity in the crisis. The financial crisis was not confined to the United States. It quickly spread across the globe, infecting economies and financial systems worldwide. The interconnectedness of the global economy meant that the crisis in America was felt in every corner of the world. European banks, heavily invested in American mortgage-backed securities, were hit particularly hard. Countries like Ireland, Iceland, and Greece, already facing economic challenges, were pushed to the brink. The Eurozone, a monetary union of 19 European countries, faced its most severe test since its inception. Emerging markets also felt the heat. As global trade and investment contracted, many developing countries saw their economies slow dramatically. The crisis exposed the vulnerabilities of a globalized financial system, highlighting the speed and ferocity with which a crisis in one part of the world could spread to others. The global nature of the crisis necessitated a coordinated international response. The Group of 20, a forum for the world's largest economies, became the main platform for coordinating global efforts to combat the crisis. Section 6. The domino effect, job losses, and economic despair. The human cost of the financial crisis was immense. As businesses struggled to cope with the economic downturn, millions of people around the world lost their jobs. Unemployment rates soared to levels not seen since the Great Depression. In the United States, the unemployment rate peaked at 10.8% in October 2009. Millions of Americans lost their homes to foreclosure, and the poverty rate increased dramatically. The crisis wiped out trillions of dollars in wealth, leaving many families financially devastated. The social and psychological effects of the crisis were profound. The loss of jobs, homes, and savings led to increased levels of stress, anxiety, and depression. Communities were torn apart as people struggled to cope with the economic hardship. The financial crisis was not just an economic crisis, it was a human crisis. It exposed the deep inequalities that existed within societies and the vulnerabilities of a global economic system that had prioritized profit over people. Section 7. A glimmer of hope, the road to recovery. The darkest hour is just before the dawn. As the initial shock of the crisis began to subside, a long and arduous road to recovery lay ahead. Governments and central banks around the world implemented a range of measures to stimulate their economies and restore confidence in the financial system. The U.S. government, under newly elected President Barack Obama, launched a massive stimulus package aimed at boosting the economy and creating jobs. The Federal Reserve maintained its low interest rates and implemented quantitative easing, a policy of injecting money into the economy by purchasing assets. Slowly, painstakingly, the global economy began to recover. Stock markets rebounded, businesses began to hire again, and consumer confidence gradually returned. However, the road to recovery was uneven and fraught with challenges. The crisis left behind a legacy of debt, both public and private. Governments had taken on trillions of dollars in debt to fund their rescue packages, while individuals and businesses struggled to manage their own debt burdens. The scars of the crisis ran deep, and the world was forever changed. Section 8. Rebuilding the system, new regulations and reforms. In the aftermath of the crisis, there was a widespread consensus that the global financial system needed to be reformed. The crisis had exposed the inadequacy of existing regulations and the need for stricter oversight of the financial industry. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010. This landmark legislation introduced sweeping reforms to the financial industry aimed at preventing another crisis like the one that had just occurred. The Dodd-Frank Act addressed a wide range of issues, from regulating derivatives to creating a new Consumer Financial Protection Bureau. It aimed to increase transparency in the financial system, strengthen consumer protections, and limit excessive risk-taking by financial institutions. Internationally, there were also efforts to strengthen financial regulations and improve coordination among countries. The Basel Committee on Banking Supervision, a global standard setter for banking regulations, introduced stricter capital requirements for banks, making them more resilient to shocks. Section 9. Lessons learned and the path forward. The global financial crisis of 2008 was a stark reminder of the fragility of the global financial system and the devastating consequences that can occur when risks are ignored. It taught us the importance of sound financial regulation, the interconnectedness of the global economy, and the human cost of economic crises. The crisis also highlighted the need for greater financial literacy among the public. Understanding the basics of personal finance, investing, and the financial system is essential for individuals to make informed decisions and protect themselves from financial risks. As we move forward, it is crucial to remember the lessons of the crisis and remain vigilant in our efforts to prevent a repeat of this devastating event. The road ahead will undoubtedly have its challenges, but by learning from the past and working together, we can build a more stable, equitable, and resilient global financial system.